Fade in, a towering Wall Street monolith, its glass facade reflecting the frantic swarm of brokers below. But as the camera pulls back, the reflection warps, revealing not traders in suits but families evicted from foreclosed homes, bread lines snaking through shadowed alleys, factories shuttered like forgotten tombs. The year is 1929. Black Thursday erupts, ticker tapes avalanche, fortunes vaporize in hours. Yet in the smoke-filled boardrooms above, a select few lean back, cigars aglow. The crash that buries millions leaves them unscathed, stronger. Why? Because in the machinery of money, collapse isn't chaos, it's calibration. This paradox pulses through history like a hidden heartbeat, every tremor in the economy, every bust that breaks the world, rebuilds the banker's citadels higher. It's no accident of fate, but the elegant design of a system where debt is the lifeblood, and crisis its most potent elixir. To understand why, we must trace the veins back to their source. The alchemy of fractional reserve banking, born in the shadows of medieval goldsmiths, perfected in the forges of industrial empires. Picture 17th century London, where goldsmiths stored wealth in vaults, issuing receipts as promises of metal on demand. A clever insight. Depositors rarely withdrew all at once, so they lent out portions of the gold, pocketing interest on idle reserves. From this spark ignited fractional reserve banking, the engine of modern finance. Banks hold but a sliver, often 10% or less of deposits in cash, unleashing the rest as loans. Each loan births new deposits elsewhere, multiplying money like a fractal storm. By the 20th century, this multiplier effect swelled economies, fueling railroads across continents, factories belching progress. But it sowed volatility too, booms bloated with borrowed dreams, vulnerable to the prick of doubt. Enter central banks, the unseen conductors. Established in the 19th century, the Bank of England in 1694, the U.S. Federal Reserve in 1913, they wield the levers of liquidity. Through open market operations and reserve requirements, they calibrate credit flows, ostensibly to smooth cycles. Yet as the Roaring Twenties roared into thunder, the Fed's easy money, low rates, lax oversight pumped speculation. Stock prices soared 400% from 1922 to 1929, untethered from real value. Farmers borrowed to chase phantom harvests, households to buy radios on tick. When the bubble burst in October 1929, $30 billion evaporated, equivalent to $500 billion today. Industrial output plunged 47%, unemployment clawed to 25%, 9,000 banks crumbled, wiping out $7 billion deposits. But amid the rubble, survivors thrived. Surviving banks, now fewer and fiercer, consolidated power. Deposits funneled to giants like J.P. Morgan, who orchestrate rescues for the elite while small institutions perished. Profits for remaining banks held steady, even as the nation starved. Corporate losses hit $1.5 billion in 1932, yet banking ledgers stayed black through shrewd foreclosures and hoarded liquidity. The crisis weeded weaklings, granting victors monopoly on credit. By 1933, when FDR's New Deal injected federal lifeblood via the Reconstruction Finance Corporation, lending billions to prop up banks, the stage was set. Recovery bloomed, but not for all. Wages fell 42%, while bank assets rebounded, paving a gilded path to post-war dominance. Fast forward to 2008, the echo amplified in a global coliseum. Deregulation in the 1990s, repeal of Glass-Steagall, the Fed's blind eye to derivatives, unleashed subprime sorcery. Banks bundled toxic mortgages into securities, rated tilted away by complicit agencies, sold worldwide. Leverage ratios ballooned. Institutions like Lehman held $30 in assets per $1 of capital. When housing peaked in 2006 and cracked, defaults rippled like dominoes. Bear Stearns teetered. Lehman imploded, firing 10,000 souls. Credit froze. GDP shrank 4.3%. 8.7 million jobs vanished. Governments surged to the breach, not with pitchforks, but purses. The U.S. alone unleashed $700 billion via TARP, plus trillions in Fed guarantees. Low rates at zero, quantitative easing flooding $4 trillion into veins of finance. AIG pocketed $182 billion, repaying with $22.7 billion profit to taxpayers. Banks like Goldman Sachs bailed with $10 billion, clawed back strength. Bonuses hit $18 billion in 2009. JP Morgan swallowing Bear Stearns at fire sale prices, assets swelled 40%. Globally, IMF and World Bank funneled $1 trillion in rescues, prioritizing liquidity for lenders over debtors. By 2010, bank profits soared 80% from troughs. Stock prices tripled by 2013. The crisis engineered by excess was resolved by more, socializing losses, privatizing gains. At the core lies the mechanism, asymmetric armor. In booms, fractional reserves amplify lending, inflating assets banks own, stocks, real estate, derivatives. Crises deflate these, but central banks intervene as lender of last resort, injecting base money to backstop balance sheets. Bailouts convert public trillions into private equity, often at discounts. Foreclosures yield cheap properties, distressed sales, bargains. Moral hazard calcifies. Executives, shielded by limited liability, chase short-term yields, knowing too big to fail guarantees salvation. Data bears it. Post-2008, the top 5 U.S. banks' share of assets jumped from 30% to 45%, echoing 1929's consolidations. Wealth concentrates. The 1% captured 95% of recovery gains per economists. Today, in 2025, the script replays on a grander canvas. Global debt crests $315 trillion, 235% of GDP per IMF's ledger, fueled by post-pandemic largesse. Public burdens near 93% of output, private 143%. Emerging markets gasp under $31 trillion loads, servicing $487 billion yearly while growth stalls at 3%. Central banks, scarred by 2022's inflation spike, hike rates to 5%, squeezing borrowers. Yet whispers of downturn loom. U.S. commercial real estate sags. China's property ghosts haunt $9 trillion in shadows. Bankers? Their vaults brim. 2024 profits topped $1.5 trillion worldwide, dividends flowing as shares hit records. This isn't malice, but momentum. A system where crisis culls competition, crystallizes control. Human stakes mount, 88 million more in poverty since 2020 per World Bank, while power accrues upward. The 1929 breadlines birthed social safety nets. 2008's evictions, Occupy's roar. Yet reforms falter. Dodd-Frank diluted, Basel III bent by lobbies. As the camera pans from marble halls to migrant caravans, a quiet truth emerges. Economies aren't machines to be mended, but mirrors of mastery. Bankers grow richer in collapse not by theft, but by thriving where others fracture. Guardians of a garden where thorns yield the sweetest fruit. The cycle spins on unless we rewrite the rhythm, will we?